Welcome back. Now, the internet and social media are fueling the DIY boom, from home improvements to cars. But even with step-by-step guides, sometimes you almost get it right. Sometimes it can be perfect or it can go horribly wrong. Perhaps you'd like to try DIY as far as investing is concerned. You managing your own investments. What do you need to know to make a success of it? Duma Mxenge, Head of Business and Market Development at Satrix, joins us with more insight. Duma, thanks so much for your time this afternoon.
Thank you.
And let's start there. A DIY approach to investing, right? What does that look like in practical terms?
Yeah, sure. I think before we even get to that, and you've touched on it in terms of, why we're even talking about DIY, right? Is that what we've seen in the market, and this is the evolution of technology, is that what we've seen now, a lot of investment service providers are providing what is called a digital investment platform. Mm-hmm. And in that way, it provides ease of access and also makes it easier for people to invest. Secondly, it also has to do with the generational mix. So the Gen Zs as well as millennials don't really want to go to, let's say, to the bank or speak to the broker. They want to try it out themselves. So, and also you've got the creator economy. So everyone is super fay with the social media platform, and everything for them is all about doing it themselves. So it does give a flavor of people are in control of their investments, and that's why we're seeing a great interest around DIY investing.
So people, yes, control of their investments, but surely there are risks associated. You mentioned here that, yes, you don't need a finance degree, but you need some sort of skill set to get through it.
Absolutely. So it goes hand in hand. If you're going to do any discipline, it does not even have to be investment. You need to actually do a bit of learning. And what's beautiful about investment is that information is readily available, whether it's media platforms or, again, service providers such as ourselves, where we actually have webinars where we invite all people, walks of life, who are actually interested in investment. And that's how you actually start off, because you need to be proactive. This is not something where you think you invest now and you're going to make money, within a short space of time.
Does this diminish the role of the, financial advisor per se?
I don't think so. I think it fuels it. What we've seen in terms of, just the growth trajectory of most investors is that they start off as self-directed, which is DIY. They do it themselves. They do get to a point where their portfolio is big enough where they say, hang on, now I actually need expert advice. Whereas your traditional advisory model is that you need to wait until you have money before you can actually afford an advisor. So I think it's very complementary.
And what kind of products are consumers most attracted to? You mentioned that, you hold some of these events and people do come through. Where are they putting their money?
Well, if you speak to any young person, unfortunately, they're going to talk cryptocurrency, and we took them out of it. We say, no, that's not where you start. So we then encourage, the whole point of actually being invested in a product that actually gives you diversification. And you'll hear that a lot, from any, investment professional, is that the key to investment is diversification. So don't put your eggs in one basket.
And you also speak about this in your presser, about aligning investments with risk tolerance.
Correct. Again, and just maybe to unpack what that looks like. So let's use an example around risk tolerance, right? Is we look at two things, your goal as well as the time horizon. So if you are, let's say for argument's sake, nearing to retirement, and you have a certain feel that you actually haven't grown your money enough, then you take undue risk. And typically, let's use the example again of cryptocurrency. It is very volatile. You do run the risk of actually losing more than you're going to gain. So we encourage people, as they get closer to retirement, to look for assets or funds or product which are less conservative. And the only way you can probably try and retire with great dignity is to contribute more closer to retirement, but not try and go for a much riskier approach. However, if you are young, that's what we do encourage, because riskier assets typically also come with high returns.
Yes.
And also because you are young, the benefit of compounding, being stayed invested, also works to your advantage.
That was going to be my next question around someone that's nearing retirement, right? And, let's say here I am nearing retirement, but I'm looking at my savings and they're not enough. And one would then make, I guess, the risk or make that big move to try and invest in a more riskier sort of asset.
I guess when you're nearing retirement, the last thing you don't want to do is to DIY it. And unfortunately there you need to have, the level of humility to actually have an engagement with a financial advisor. You know, I may actually say one thing now, but you need to have a holistic approach in terms of, you know, how can we make it work? And that's where I think financial advisors play a key role.
Now, many people, many consumers also struggle with consistency.
Correct.
Once, you know, that excitement dies down. How can DIY investors then build habits that can keep them engaged and accountable for those investments?
I tend to look at it like going to gym, you know. If you don't go to gym, you know, quite regularly, unfortunately, you're not going to see the results.
Yeah.
And the same thing applies here. So we are saying that you don't have to wait until you have huge sums of money. You can start small. As I said, you know, these digital platforms do now provide people to actually start with small amount, learn about the market, because the learning is also a key component. And then lastly, to your point around consistency, is we do encourage people not to look at one-off investments, rather to do a debit order. And what that does over a 5-year period, if you invest in the right products, is that you do see the desired results.
Builds the habit.
It does.
Duma, there's so much information online, and I always ask myself how a beginner then sort of knows what's reliable, what's credible advice, and what's just noise.
Yeah, it is a tough one, and this is also something that, you know, the regulator is looking at. So the conundrum we have is that your big brands out there need to be very careful in terms of how they position their products. So it's typically just high-level explanation of what the product is all about, and there is financial education that's attached to it, and all the big brands do it, and you can find them in various social media platforms. However, where we've seen stickiness and impact is actually around your content creators, who have actually built a brand for themselves. And unfortunately, that space hasn't been regulated, and I think there are steps to do that. Is that if the regulator does get it right, and you have these components of people who are seen to be independent, talking about financial products that you may consider, I think that would also be a nice bridge to actually get people started and also curious and excited about getting to the investment world.
Now, we know that the whole DIY investing trend is also being fueled by the fact that you're not paying as much fees, right? And what practical steps can investors take to, I guess, understand and manage costs tied to their investments? Because there's still costs nonetheless. It might be lower, but there are costs.
No, you're 100% right. Like in every single product, the big thing that you need to ask yourself is you need to ask a lot of questions before you actually invest in this product. Understand that there may be various layers of fees, and don't take that as because this product owner is saying these are the fees, this is a standard practice. Try and also shop around and look at what else is out there. And the reason why you're mentioning fees and why fees are so important is that the higher the fees actually eat up on your returns. The lower the fees, it means that you're paying less, therefore you're actually benefiting more on the compounding effect. So it's very important to spend some time understanding the fee component of any product or investment product that you invested in.
All right, let's leave it there, Duma. Thanks so much for your time and sharing your insights with us this afternoon.
It's a pleasure.
That was Duma Mxenge, Head of Business and Market Development at Satrix.